The US dollar has been the cornerstone of global finance, yet even this mighty currency is not immune to crises. Rising national debt, inflationary pressures, and declining investor confidence can destabilize the dollar, prompting a global shift toward safe haven assets. Gold and silver, in particular, become critical tools for preserving wealth. The gold-silver ratio serves as a barometer of market sentiment. When fear dominates, gold typically outperforms silver, causing the ratio to rise. Investors watch this indicator closely to anticipate broader market shifts. Historical crises demonstrate that sudden swings in the ratio often mirror dollar weakness, revealing patterns in capital allocation that are crucial for understanding the dynamics between currencies and precious metals. The ratio is more than numbers. It's a window into collective market psychology and the silent flow of wealth across global economies. Gold has been humanity's refuge against uncertainty for centuries. During periods of economic turbulence, including devaluation of currencies, investors flock to gold to preserve wealth. Its stability often makes it the first choice when fear spreads across markets. When gold outpaces silver, the gold-silver ratio rises, reflecting heightened risk aversion. Gold's symbolic and financial roles reinforce its dominance during crises, serving as both a store of value and a psychological anchor. Tracking gold's performance provides insight into the market's perception of safety. It is not merely an investment. It represents trust, security, and a hedge against the unpredictability of fiat currencies. Understanding these dynamics is critical for anyone seeking to anticipate the behavior of precious metals when the dollar faces downward pressure. Unlike gold, silver is both a precious metal and an industrial commodity, making its price more sensitive to economic shifts. Demand from technology, manufacturing, and renewable energy sectors adds layers of complexity. In times of crisis, silver often lags behind gold, causing the gold-silver ratio to spike. However, silver's volatility creates opportunities. Sharp corrections or revaluations can offer significant gains for strategic investors. Understanding this duality is essential for portfolio planning. By tracking the ratio, investors can identify when silver is undervalued relative to gold and anticipate potential reversals. Silver's behavior provides clues not only about precious metals but also about broader industrial and economic trends, reflecting the intersection of real-world demand and speculative. The gold-silver ratio has swung dramatically during major financial crises. During the 2008 global recession, the ratio surged as gold outperformed silver, illustrating its role as a market barometer. Currency collapses and periods of economic uncertainty often produce temporary peaks in the ratio. Studying these historical trends provides investors with critical context for anticipating potential reversals. Patterns in the ratio reveal investor psychology, monetary policy impacts, and industrial demand shifts. By understanding past fluctuations, investors can better navigate modern markets and anticipate opportunities for rebalancing portfolios. The ratio acts as both a mirror of history and a predictive tool, revealing insights that extend beyond simple pricing metrics into the behavior of markets under stress. Inflation erodes the value of paper money, increasing demand for tangible assets like gold and silver. Gold serves as a reliable hedge, maintaining value across centuries. Silver's industrial use adds complexity. Its price reacts to both inflation and economic activity. When inflation spikes, the gold-silver ratio often rises, reflecting gold's stability versus silver's sensitivity. Investors analyze these fluctuations to safeguard wealth, understanding how macroeconomic policies, currency devaluation, and central bank actions impact precious metals. Monitoring the ratio in inflationary periods provides insights into market confidence and highlights potential entry points for investors seeking protection or profit in uncertain economic climates. The ratio becomes a quantitative representation of risk perception and hedging behavior. Central bank actions directly influence the dollar's value and precious metal prices. Rising interest rates can temporarily strengthen the dollar, reducing gold and silver demand, while lower rates weaken the currency, increasing metal buying. The gold-silver ratio responds to these policy shifts. Rapid changes in monetary policy often produce spikes in the ratio. Investors track these signals to anticipate profitable opportunities and assess systemic risk. Understanding the relationship between interest rates, currency strength, and metal performance is critical. The ratio provides a measurable reflection of the market's interpretation of central bank decisions, blending macroeconomic fundamentals with investor psychology and revealing potential turning points in precious metal trends. Market psychology drives the gold-silver ratio as much as economic fundamentals. During panic, gold often rises faster than silver, widening the ratio. Optimistic markets can reverse this, with silver gaining relative to gold. Behavioral factors such as fear, greed, and herd mentality amplify the ratio's swings. By analyzing market sentiment, investors can anticipate extreme points where metals are over or undervalued. The ratio becomes a lens into human behavior within financial markets, revealing not just price movement, but collective emotion. Understanding this psychological element allows strategic decision-making, especially in volatile periods where emotional responses dominate market outcomes. Wars, sanctions, and trade disputes profoundly impact currencies and metals. Gold is often the first refuge, while silver reacts variably depending on industrial disruption. During geopolitical shocks, the gold-silver ratio often spikes as investors prioritize security over industrial-linked assets. Historical events demonstrate how sudden crises create short-term imbalances, followed by gradual normalization. Tracking these geopolitical triggers allows investors to use the ratio as a predictive tool for metal movements. It is both a reflection of global tension and a measurable indicator of how markets redistribute risk across assets when uncertainty dominates. Gold and silver supply influences the ratio independently of demand. Gold production is relatively stable, while silver output is more sensitive to mining, recycling, and industrial usage. Supply disruptions can spike the ratio as scarcity affects pricing. Investors can use these insights to predict temporary imbalances, exploiting periods when silver is undervalued relative to gold. Understanding production trends and supply shocks adds depth to ratio analysis, providing a comprehensive picture of precious metal markets beyond pure speculation. It demonstrates how tangible constraints influence abstract financial indicators. Silver's industrial applications in electronics, solar panels, and medical devices make it uniquely sensitive to technological growth. Advances in demand-intensive sectors can tighten supply, influencing the gold-silver ratio. Rapid adoption of technology can temporarily reduce silver availability relative to gold, increasing the ratio. Investors must monitor industry trends alongside macroeconomic indicators. The ratio thus becomes not just a measure of precious metal value, but also a reflection of technological progress, industrial demand, and economic adaptation to innovation. During severe financial crises, extreme spikes in the gold-silver ratio can occur. Predicting these scenarios requires analyzing dollar strength, inflation, interest rates, geopolitical risk, and investor psychology. Historical data suggests that after peaks, silver often catches up, causing ratio normalization. Savvy investors anticipate these reversals, balancing portfolios between short-term security and long-term gains. Understanding the interplay between macroeconomic pressures and precious metal performance helps forecast market behavior. The ratio acts as a predictive compass, guiding decisions during turbulence and revealing which metal is likely to lead in recovery. The gold-silver ratio is more than a number. It's a strategic guide. By observing historical patterns, market psychology, and macroeconomic indicators, investors can position themselves for optimal risk-adjusted returns. During dollar crises, gold often leads, but silver's recovery can be lucrative. Understanding these dynamics helps investors anticipate shifts, hedge exposure, and exploit mispricings. The ratio encapsulates complex market interconnections, blending macroeconomic fundamentals, industrial demand, and human behavior into a single, actionable metric. Mastery of this ratio can provide both insight and opportunity in uncertain financial landscapes.